Welcome to StockOdds. This is another StockOdds podcast, Odds and Ends with Dave Singh and Rob Friesen. Good evening, Rob. How's everything?
Not too bad. Thank you for putting this together tonight here, and I'll let you kick it off.
Yeah, we're just trying to get our bearings for the week here and see what do the odds say of what might influence trading for the week.
And I got an idea.
What's that?
Let's just first kind of recap on how we finished this crazy week. So you had some of the groups that you had indicated, in terms of how they did for the day and for the week. You want to recap that for a sec?
Yeah, I mean, on Friday, again, it was kind of a defensive day. Utilities and defensive stocks did the best, and things like technology and consumer cyclicals were suffering the most. And that theme kind of carried over for the whole entire week. Again, it was utilities and real estate were stronger than cyclical technology, things like that. And even for the month, it was still a relatively defensive posture there. And again, consumer cyclical was the weakest. So that's our backdrop coming into the current week. And we're in this kind of strange period between, we're not really at the turn of the month effect anymore. We're the last month of the year, and mid-month seasonality doesn't really start until about the 13th.
Yeah,
so
right.
We're kind of this no man's land. But if we have a perspective of what might be expected in the middle of the month, maybe we can kind of front run that with the kind of sectors and exposure we can get to. And it seems like big tech, big cap tech, is more of a defensive posture going into big items, and even IWM should outperform come mid-month. So with that perspective, what do you see in terms of factors, sectors, odds of from your perch?
Yeah, look at some of the names that had done really good. For example, in the beverage area, Pepsi was up 2.55 on Friday. In the stores, discount, Walmart was up 1.5%, and that was in a pretty poor performing day. You got Kimberly-Clark up 1.96%. Johnson & Johnson was up 1.46 in the healthcare area. Pfizer up 2.32. And then even in the telecom area, you had Verizon up 1.36%, Comcast up a little bit, Charter Communications 1.33. And then you mentioned utilities, Southern was up 1.32, Dominion up 1.67. So do you think we can count on that to sort of carry over into next week with still this uncertainty? Because now we have, I think, is it 14 states that have detected Omicron altogether?
Yeah, that's a good portion of the country starting
right?
to get. Yeah.
So, I mean, do we, because we're in no man's land, let's just carry that theme and say, okay, no man's land. We're in between seasonal events. We're in a month where there normally would be good breadth. We're in a month that normally performs pretty okay. Not like it's not super. It's just it's okay, but it's still a good month generally, and the overall breadth in the market should be favorable. But couple, that with no man's land. Do we stay with these defensive names? Can we continue in the consumer defensive area, healthcare, utilities, maybe some stay-at-home stuff like in the telecom area, maybe a few of the semiconductors. I mean, we had NXPI up 1.97, Avco was up 1.03. Not all the semis were doing fine. Remember that AMD's in a merger, that was down 4%. So obviously they were leaning on that one. Micron was down 1.52%. So it's not, you have to be selective in some of these groups. I mean, when you take telecom, that was pretty much green. Healthcare, a good portion of the major drug makers were green, and the healthcare providers. Consumer defensive, pretty much green across the board. Beverages, tobacco, confection, packaged goods, green. Utilities, green, and then even railroads was green. Delivery companies were green, but otherwise you have to be more selective, right? So I just want to know if you think we can kind of carry those themes and say press a little bit more with the Dow 30, press with the defensive names, and keep looking for companies where their valuations are ridiculous, where they're very speculative technology companies, where we're thinking about no free money going forward. Which reminds me, let's pull up I kind of created a list here of some of these catalysts that I think this is a if you were to hear some talking heads, sometimes they only bring out one idea. They just say this is the reason that we had a down week, why we had a down day on Friday. This is the reason. I think it's multi-factor. So let me list some of these and see if they resonate and if you have anything to add to it. So Omicron, obviously, when it was like, fear was dissipating, release the variants, right? We were almost getting back to business as usual. Oh no, that's not going to work. Release the variants.
Yeah.
It's not that funny, but it is somewhat coincidental, I think. So we got Omicron to deal with, and then we have the valuations. Now, Charlie Munger brought that out and said he hadn't seen this kind of, oddball valuations, since the late 90s kind of thing, right? So, there's that aspect, and there are people that do respect that. You're going to have some young people go, oh, it doesn't matter. Valuations don't matter. And I have a funny thing. I had that in my Skype the other day talking to somebody, and it was like, oh, company valuations don't matter. Earnings don't matter. If they never make any money, it doesn't matter. These things can go to the moon. It never matters until it does matter. It never matters that, cryptocurrencies, some of these alt currencies could, evaporate to nothing. It doesn't matter until it starts happening. It doesn't matter, that there could be a rug pull until there starts to be rug pulls, right? It doesn't matter that, hackers exist until they actually start hacking something of value, and then now we all got to have 3-factor authentication on everything that we do. So we've got valuations, and we got this China situation and the U.S. listings, with Didi, and the concern is that there are others could be next in the sites, and I know that we can get these significant bounces in Chinese stocks across the board, and they've been down for a long time, but I would say that the tension still is there. And the Evergrande situation, which is another catalyst, is not resolving itself. In fact, there was some real concerns Friday about that, and also coming in over the weekend, looking into next week on the Evergrande situation. So if I was generating baskets, I wouldn't select Chinese stocks, even that that some days they can bounce marvelously, right? It's just not worth the aggravation. To be long or short, so you can probably just stay away from them altogether. So China and U.S. listings, and then we have risk off in cryptos. Some have actually seen and witnessed that the crypto market moves both up have had some market leadership, meaning that the other indices follow the cryptos, and then the cryptos actually start selling off before the regular market sells off. I don't know if that's entirely true, but we did see, like you mentioned, that flash crash on the Bitcoin on Saturday morning, and it's really rolled off its highs substantially. And so what's kind of concerning overall is there's too much correlation between all the riskier assets, so that I don't think people can really argue that cryptos are defensive or an alternative when I see so much correlation. Does that make sense?
Mm-hmm.
I don't think it's one of the asset classes that you can say, well, I'm going to diversify, and I'm in technology stocks that are speculative, yes, but then I'm going to buy some Bitcoin and some Ethereum as well, because that's defensive, or that's going to hedge me against my technology stuff. I see way too much correlation.
And since it trades 24 hours a day, it's almost like a leading indicator of risk.
You're right. That's probably where the leadership comes from, is the fact that when you had the sell off in crypto overnight, and then you start to see it spill over into the day session in the regular markets. So yeah. I'm glad you pointed that out.
But it recovered. It went down to like 43,000 and then pulled back close to 50. And then now the futures on the indices are all up too, with IWM being the greatest.
Yeah, it's up the most, right? IWM's up the most, which is similar to Europe's are up right now, and Europe's up about the same amount that the Russell's up, right?
And the Nasdaq's up, but up the least. It's up 0.15. But Russell is up 1.13, a whole percentage.
Yeah, but we had that the other day, and then they leaned into it. Was up 2%, and then they leaned into it real hard and sold it down.
Yeah.
So I don't trust that. And even in fact, with Nasdaq was up on one of those days, and then they hammered it right out of the gate too. So
well,
I would be really
I just checked
careful.
out before this call was I checked out where we are relative to the 52-week high. So the Spider is 4.25% below its 52-week high, where the IWM is 12.17% below its 52-week high. So even just as a mean reversion trade for the month, being longer IWM and shorter Spider against it, the QQQs are minus 6% below their 52-week high. But so IWM is significantly below its recent high.
Right.
And that has a lot to catch up. So that plus mid-month is expected to outperform the Spider. We've got that at our back. And if we do have a risk-on kind of Santa rally, it should also perform. And your perspective of November to April being stronger for small caps. So all those things line up where maybe being longer small caps the next few weeks and even tomorrow might be a little bit of an edge.
Yeah, yes, definitely on theme here. So there's tax consideration selling. Okay, and I'm not saying just tax loss. I'm saying tax considerations. So, for example, people that have a concern about the implications of gains that haven't been locked in but still being taxed on them. Or the just fact that taxes are changing in general might be the best year to sell some. So I think, that can speed up a little bit when markets start to roll and people go, oh, wow, I've been up a lot, and I was thinking of selling and locking some profits this year, but, now it's starting to pull back on me. I better hustle and get on it. And I had a conversation with somebody that had, sizable. He had about $1 million account that had been, up to that point growing for this last year, and was pretty pleased. And he decided he wanted to sell about 60% of it and go to cash on that or reposition it. Mm-hmm. And he was quite upset that the market had already rolled over so much. So, that anxiety and that concern, and a lot of people don't time things right. They don't sell when it's still rising. Mm-hmm. Because they think, oh, well, it's still going good. And then when it starts to roll, they're not sure. So they wait, and then they wait, and then they wait, and it gets worse, and it gets worse. And then, finally they can't take it anymore. And then, you get the capitulatory events. But I think there's a lot of profit that people have wanted to lock in because things are changing. So as we look at the taper, as we look at maybe the end of the free lunch or diminishing, sustainability of the free lunch being all this money, cheap money, available capital, it's going to be ending sometime in the next year or two, probably before the midterm elections. So I think we're entering a period where the market can still go higher, but the risk is increasing. The risk of a real correction. And, we've seen a little bit of it so far. That might get worse. Maybe we'll bounce and have a good run before we really get a correction. I don't know. But then, we had some doubt created on Friday by the employment figures versus the non-farm payrolls. People were very confused about the employment report. And I don't think Biden did anything to, calm them down or encourage them. I think people are still suspicious about this whole thing, what's actually going on behind the scenes here. Then there's just general deleveraging. There's a lot of highly leveraged firms out there and in traders and so on. It's been great pressing while the markets have been good, but we are seeing some deleveraging. And now you've got also this Russia and China arms race with the hypersonic missiles and all this stuff going on. And it's like, Russia with the Ukraine, and then we got China with Taiwan. I mean, we've got a lot of new, relatively newer themes here suddenly kicking in all at the same time. So I listed quite a few factors here. Do you have anything to add to those?
No, but then I'm looking at the contrast between all the risks you just laid out, and then you look at the talking heads. Like, they keep increasing their year-end targets, and then into first quarter of next year, 5,000 on the S&P, and this and that. And there's a mismatch, right? And that mismatch is what sometimes starts the whole domino effect, right?
Well, the mismatch can create this situation where the markets have some lift, and then you start to see them. They're just going up, and then all of a sudden you see a big seller sell into it. You got to watch how the SPY and the diamonds, or the futures, if you do have the ability to watch futures, how they get hit when they're rising, and that starts to, roll over, and then we get our big down moves after that. It's like the smart money is selling into that strength. And I've seen that many times over, right? Selling into that strength. So that tells me that, there's a bigger picture going on here. And yeah, you can have talking heads lift things, but that doesn't mean it's sustainable. So when you consider these other factors, right, there's a multi-factor. It's not just one thing. You can't blame it on just Omicron or, taper tantrum or, Evergrande or whatever. It's a multi-factor thing. And I think it all contributes to some extra volatility. Look at our, CBOE volatility index. It's, it's right back up there. And as far as the year goes, we're still kind of when we should really have low volatility and good market breadth at this time of year. Especially, we just went through the turn of the month effect. Yeah. Right? And that's supposed to be phenomenal. And even into the first Friday of the month of December is supposed to be reasonably performing. And here we go. A really bad week. And it's been rocky. It's been rocky since September. I mean, we had some issues in September. We had some peaks then again in October, and then some rockiness, and then we had November start with a bang, and then all of a sudden, mid-November comes along, and we start to get this rockiness again. And here we are in December, and so it's not as pretty of a picture as it was at other times this year. So what do we do for this week? So here's my thoughts.
Okay.
I'm going to lean to the defensive names a little bit more for my long side. I'm going to be suspicious of a real strong tech rally So I'm going to lean a little bit more to the short names in things that are super speculative, don't have, the earnings potential of some of their peers, maybe have, massive amount of debt, may have difficulty, raising more money going forward. Just things that, are not super attractive fundamentally. So does that, and yet at the same time, I'm going to, for Monday morning, be still quite diversified. And the reason that I say that is because we had a bad week. We're getting a fresh start to Monday. We're getting a bit of a bounce. We have a bounce in Europe, right? China wasn't included in that bounce. Obviously, they're down, but Europe's getting a bounce across the board. It's spilling over into our futures, and the Dow and the Russell's doing the best. Dow and the SPY are doing fine, and Nasdaq is lagging a bit behind, but we have a fresh start, and so it may gain some traction. Like, we may have a reasonable up day, and it could include the financials, which were down significantly on Friday. It could include some of the semiconductors, which were mixed. It could include, even Microsoft kind of coming back. Google could come back. It wasn't down that much on Friday, only minus 0.68%. So that might come back a bit. Even Tesla could bounce back. It was down 6.42%. Elon still got more to sell on the top line, but he is buying. So he's exercising, options at like $6 something, not $1,000. His options, are like $6 or something. So he's actually, his stake in terms of shares has actually grown. So if I get the Fintel reports, Fintel.io, and it shows all the different corporate events that have happened. So he's been selling, but he's been buying, but obviously buying at a lower price because he's exercising options and buying, right? So even that word will start leaking out more, and it's not like he's decreasing his ownership of Tesla. He's increasing his ownership of Tesla, but he's selling shares, but then he's exercising options and buying shares. So when that word gets out more and more, people say, well, he's not reducing his equity ownership in Tesla, right? Which is always the concern. He's just simply got tax implications, and that's probably the driver, right? So
it's like a public misperception. He's doing
well, the
mechanical
options are a long-term tax consideration, so they're at a lower tax rate, right?
He's going through a mechanical process of stuff he has to do. Nothing to do with change in his
But
perception.
everybody, even some of the talking heads were like, "Oh, he's selling." But, hey, listen, I never worry about insider selling. What's a flag to me in a good way is insider buying. But I never am concerned about insider selling ever, because number one, they're never good at timing the market that way. Even though they work within the company, they're still not good at timing the market. And number two, selling is a natural function of being involved in the company and, working and building the company and hitting your mile markers, and, it's part of your compensation. So insider selling is not a signal to me. I don't know why people keep bringing that up all the time. It just drives me up the wall.
No, they're saying, oh, Bezos is selling, Musk is selling, so this must be some kind of leading indicator that the market's going to crash. And maybe it's the opposite.
Oh, bah humbug. Yeah. It has nothing to do with timing the market. It has nothing to do with the company being overvalued, or they don't have an interest in it. It's just a natural function of being involved in a company.
Yeah.
But now, if you reach into your pocket and take out good hard cash that you've been earning in wages, and you buy your own shares at market price, usually on a bigger tender above market price, now that shows commitment. That shows that there's something going on here. So that means something to me, but not the selling.
Yeah.
Anyway, I don't care for all that nonsense that gets talked about in the media all the time anyway. So all right, well, so that's the game plan is we can be a little bit more diversified, a little bit of more of a defensive posture. We can always wait with the ETFs if we see that, hey, the market there's really more and more confidence coming into it. We can always add a little bit of weight and pick up some directional move. We can always add a little bit to some good winners out of the gate and that are holding up. So there's lots of potential for directional trading in relationship to being hedged. But then we'll get information more for Tuesday, and from the Monday out of the gate. So then Tuesday, we might be a lot more opinionated at that point than we are now with this. So.
Yeah, if we're able to hold on to these gains that we currently have, that's a different story than losing it all.
Yeah, absolutely. So, anything else to add?
No. So good luck, good trading, and
okay. All right. Well, great talking with you. Good trading tomorrow.
Thanks. Bye-bye.